Hey, this is Justin with TradetheMarkets.com, and in this video I wanted to talk in theory and then show an example from today's trading and talk about just again in theory the idea of strategies for trading choppy markets versus trending markets, and then more importantly how you can determine when a market is more likely to be in the consolidation or choppy mode versus what we call a vertical or a trending breaking out type of a mode. You can see from today's trading, and I'm doing this video should apply to any time, but I happen to be doing this video on July 17th 2013, and it's a very choppy day. You can see our range was about 6-7 points on the ES. This is a 1-minute chart, and you could look at any time frame with this software. I'm going to break this chart down a little in more detail in just a moment, but I wanted to first talk more about a strategy, basic strategy for choppy versus trending markets. Okay, so as a beginning point, when a market is in consolidation or what people call choppy market, the ideal strategy is to fade the extremes of the consolidation. In other words, to be a seller at the highs of the consolidation that you were able to identify, and to be a buyer at the lows of the consolidation that you were able to identify. Okay, and now obviously if that's with the bigger picture bias, you have less risk. So in other words, if your bigger picture bias or longer term outlook is say bullish, and you're fading the lows of consolidation or buying the lows of consolidation, you have less risk than if you're trying to fade or sell the highs of the consolidation in a bigger picture up market. Okay, so that's again just generically speaking, that's the strategy for a consolidation or a consolidating or choppy market. Okay, now just as an aside before I give an example, I think that's a mistake that so many traders tend to make, and I talk about this a lot, so bear with me. But a lot of traders, and I think a lot of us are taught to take trade setups. Okay, so we have these rule-based if A and then B and then C and then D happen, then we're taking a trade. Okay, and if a lot of people are taught to be with the trend, or some people are fade traders, and what happens is if you're a trend-based trader and you get a trade signal, but the market's in consolidation, you're kind of screwed, right? You're going to get your head ripped off. Versus, if the market is, if you have a momentum or a trend following type of a trade setup, and the market happens to be in the vertical or breakout or trend phase, well then you're in good shape. Okay, but if you can kind of flip that script and instead first determine, is this market trending, or is this market in the vertical, versus is this market choppy or in the consolidation phase, then you have a lot bigger edge on the market. Okay, so I just think that's important. It's what we call context first, then trade setup. So we want to figure out which phase the market is in. Is it consolidating or is it vertical, so that we can go with that. Okay, so just as an example of a consolidating market, this is just a generic market. If you can identify, and I'll talk about how to do that, if you can identify that a market's in consolidation, I mean obviously your ideal scenario is you want to be a buyer toward the lows of the consolidation, and you want to be a seller toward the highs of the consolidation. Okay, that's your lowest risk type trades. And if you can do that with the bigger picture bias or with the longer term outlook, then it's even better. So if your longer term outlook is bullish, then this is a lower risk trade, being a buyer at the lows of consolidation versus being a seller at the highs of consolidation. Okay, now conversely, if the market is in what we call a vertical mode or breakout or trend type of a situation, the strategy is to go with that move. You don't want to be, if the market's breaking out to the upside, you don't want to be trying to pick the high, right? You don't want to be trying to fade that market. You want to be going with that. You want to be riding the train, okay? And obviously, once again, if it's with the bigger picture bias, it's less risk. But with a vertical type move, if you have pretty good evidence that the market's breaking out or trending or in a momentum type of a phase, you want to try to ride that train in some form or fashion. So just going back to this example, if, for example, we were to get some indication, and I'll talk about this in a second, that this market was truly breaking out, in our case some really strong aggression that has some follow through, well then this market's no longer in consolidation. Now it's in a vertical or breaking out type of a trade or type of a scenario, and you want to look to go with that market. You want to jump on that train. Okay, so that makes sense. Hopefully that makes sense in theory. If not, I'd say run this back, but that should make sense in theory, right? But theory is a lot different than real time or doing it live. And so the idea is then, how do you better you're never going to be 100%, but how do you better determine when a market's in consolidation versus when it's breaking out or trending or in the vertical phase? There are a few ways that we like to do that. One, I'll just go through these, one by one and show an example from today. But again, this would apply to any. It wouldn't have to be today. This would apply to any day. Okay. So One of them is what we call our bigger picture key levels. And I like to think of these as rungs of a ladder. Okay, so we have a bigger picture support level below the market and a bigger picture resistance level above the market. We want to see what the market does when it tests those levels. Okay, does the market break out above that? And if so, it's probably going to go test the next rung higher. Or does it stay consolidated at that level? Then it's probably going to go test the next rung lower. And we see what the market does at that level. Okay, so for example, if we look at today, and what we do is every night in our member center we have a pretty detailed report, and we actually have a pretty decent sized member video that we do with some information. You can pause this and look at it, but I'll just kind of point out the key things. What we were looking at heading into today. So this was put out last night. This was put out on Tuesday night, the 16th, for the 17th. Okay, following the 16th, heading into the 17th, okay, which is today. Here's some news we want to look at, and obviously we know the market might get a little volatile at 10 Eastern. That's an Eastern time. But what we were basically looking at is the 1680 has been a resistance area over what it was the high a couple months ago, and it's been a resistance area over the past few days. Okay, so we definitely want to watch that 1680 area, and we also then we want to see how the market would do at the 1667. And when we opened, or when we closed yesterday, we were below this 7250 to 7450 zone, okay, and then we were below this 80 zone. Now when we opened, okay, now you can pause that and look at it, but we teach you how to make more sense of this, and we have a video that goes through this every night. But this is the idea, and our bigger picture bias is certainly up in this case, okay? And the scenario in which that would change would be if the market got below this level for a good period of time, okay? So if we look at that level, and we're focusing on the 1680, this zone from 7250 to 7450, and then 67, okay? Heading into the day, this is what we would want to look at. Okay, so you can see we closed here below this 72 to 74. This was at the end of yesterday. So we want to see how the market would react at 67. Draw a line at 67, see how the market would react. We want to draw this zone between 72.50 and 74.50. Okay, and then we also want to be aware of this level up here at 1680. So this is heading into the day. This is prior to any of this chart activity happening. Okay, but that's what we want to think about in terms of those rungs of a ladder. So if you think about this in terms of rungs of a ladder, we ask ourselves, okay, is the market above or below these, and what happens when it tests there? If the market goes down to 67, does support hold as we would expect, like it did yesterday? Okay, if the market goes up to 72.50 to 74.50, does it act as support, or do we get above it? Now in the overnight, we actually took that out, so it's a different story when we open up here. Now we want to ask ourselves, if the market tests down into this 72 to 74 area, will it act as resistance, or excuse me, will it act as support, or do we bust through it? If so, we're likely going to go test this level. Okay, now if this acts as support, then we say, okay, we're likely going to go test this 1680 level. Let's see what happens there. Okay, but that's the idea. That's the first step, is that bigger picture idea. Okay, so that's kind of your game plan, bigger picture heading into the day. Okay. The next thing is what we call our real-time support resistance zones. These are giving you pretty good clues as to whether this market's in consolidation or whether this market's in more of a vertical phase. Okay, so going back to today's trading, right around 10:30, 10:45, we had a zone that formed right here, and you can see on the low end is a support, on the high end as a resistance. So what that's telling us is once that forms, that this market's in a bit of a consolidation. If we were to break below it, and we have some formulas that show if it's a real breakdown below, or if we were to break above it, then for example, if we broke below it, this instead of being green would turn to red. If we broke above this, this would turn to green. Okay, so instead of being in consolidation, shorter term in the real time, this is another clue that's giving you an idea of what the market's doing. Is it in more of a consolidation phase, or is it in more of a vertical phase? Okay, so that's kind of the second way that we go about doing it. Okay, and now a third way to kind of determine if the market's likely to be in consolidation versus if it's likely to be in a vertical phase is by looking at what we call extreme buying and selling aggression bars and asking ourselves, is there follow-through or is there rejection? So for example, if we get to the high of what we'd expect to be, consolidation, so in other words, we get to a resistance point, like today when we got to 1680, we ask ourselves, do we have a level 3 or extreme buying aggression bar on the high of the day? And not just that, because we know that could be an area of resistance, but do we get some follow through? If we do, it's a very, very good sign this market is likely to continue and that the vertical phase is underway and we want to ride that train higher. If not, if there's rejection, that's telling us it pretty clearly that the attempted vertical move failed. That level 3 was capitulation instead of the beginning, and that we want to be careful. This market is still in consolidation, so you either want to be a fade trader or just stand aside and wait for that type of a breakout. Okay, so and we talk about this a lot in our videos, but just as an example, we have these relative aggression bars, and these are showing in real time which side, buyers or sellers, are more aggressive than the other and to what degree. So when I talk about level 3 or extreme, they're pretty rare, but they're these blue and magenta bars, and you can make them any color you want. And again, do we have follow through or do we have rejection? Okay, so if we go back to today's market, and obviously today was a pretty choppy day, but you don't know that as it's happening necessarily. But if we go back to today's market, and again, our context is that we would expect some kind of support in this area, bigger picture. And then once this green area formed, we would expect some kind of support there. And then bigger picture, we would expect some resistance at this 1680. And then once this shorter term resistance formed, we would expect some resistance there. Okay, so that's our context. Okay. Now, what happened is when we tested up into this 1680 area, you can see we did so on a level 3 buying aggression bar. We started at a point below. We started at 1679. We tested above that by 2 ticks, and you can see that by the time that bar closed, it was back under 1680. The very 2 bars later, we had taken out the low. Then we had some selling that started to come in. That's telling us, and more often than not, that's going to be the beginning. But what would have happened is if we would have gotten some follow through above, that's a very good indication this market wants to take off. We're going to make new highs, ride the train. The fact that it didn't, the fact that we got right away, this market turned around, took out the low, selling came in, here's a selling high velocity move, that says we're in consolidation, and we're probably going back and testing this zone from 72.50 to 74.50, and that's exactly what happened. We found support there again, but the same logic would have been if we would have broken down lower and done so on, say, a level 3 selling aggression bar, and then, had some follow through below that, then it's saying, okay, we're more in a vertical phase down. We're probably going to go test this 67 level. Okay, so that's kind of a way that you can put the market in context. That you can look at like I said, the context. Is the market in consolidation? Is the market in a more vertical phase? And you can adapt your strategy and make sense of that. I'm not going to get into different trade setups that we talk about and that sort of thing. But again, the trade setup is the lesser of importance. Behind putting the market in context, behind being able to determine if the market is vertical, if the market's in consolidation. Okay, so hopefully that makes sense. And the idea is you just put these pieces of evidence together, and it takes a little time, it takes some experience, but we try to shorten that learning curve very quickly and have some good tools. And what you'll also find, this was obviously a very consolidating day where we really got no follow through on any. We had one level 3 bar on the high of the day with no follow through. We didn't even have a level 2 or level 3 bar on the low of the day. Now we had a buying reaction right there. That's a pretty good indication there. But we didn't have any strong selling on the low, and the only strong buying we had on the high had no follow through. And what you'll find with vertical moves, and we've certainly got a lot of videos that show this as well, but what you'll find with vertical moves is you will rarely, I'm not going to say never, but it's almost never. You will rarely see a vertical move higher that doesn't start with a level 3 bar. Okay? That doesn't mean every level 3 bar, just as this proves, that doesn't mean every level 3 bar turns into a vertical move, but you will very rarely see a vertical move that doesn't begin with a level 3 bar. Okay? So just some things to think about, some ways to stay on the right side of the market, some ways to be able to better understand whether you are in consolidation or whether you're in a vertical market, so that you can have the proper strategy to either fade the extremes or stand aside if it's choppy, or to ride the train or go with the breakout or the trend. So hopefully that makes sense. And if you have any questions about that, certainly let us know. We'll be happy to clarify anything, and we'll talk to you soon. So again, I keep going here, but let me just keep going. This is a thinking person's type of way to look at the market, but unfortunately, and I wish there was a shortcut around that, I don't know of any other way to trade other than to be someone who likes to think and try to make sense of the markets. So this certainly can help, and I hope it does, and let us know any questions that you might have. Talk to you later.